Imagine this: you've done your research, you've picked a stock, and you're convinced it's the next big thing. Weeks pass, the price drops, and instead of cutting your losses, you hold on tighter, telling yourself it will bounce back. Sound familiar? That's not just a bad investment decision, it's a bias at work. Investor biases are sneaky. They don't announce themselves. They whisper in your ear, nudging you to make choices that feel right in the moment but quietly drain your wealth over time. Here's the surprising part: even seasoned professionals fall into these traps. Billion-dollar funds have lost fortunes because of the same psychological quirks that trip up everyday investors. So today, we're pulling back the curtain. We'll explore the hidden biases that cost you money, why they're so powerful, and how you can spot them before they sabotage your financial future. Stay tuned, this might change the way you invest forever. To understand investor biases, we need to step back and look at where they come from. Investing isn't just about numbers, charts, and balance sheets. It's about human behavior. And human behavior is shaped by psychology, our instincts, emotions, and mental shortcuts. Psychologists call these shortcuts heuristics. They're useful in everyday life. For example, if you hear thunder, you assume rain is coming. That's a quick judgment that usually helps. But in investing, these shortcuts can backfire. Markets are complex, unpredictable, and influenced by countless factors. When we rely on instinct instead of analysis, we often misjudge risk and reward. The study of these biases really took off in the late 20th century, thanks to researchers like Daniel Kahneman and Amos Tversky. They showed that investors aren't perfectly rational, as traditional economic theory once assumed. Instead, we're predictably irrational. We make systematic mistakes, and those mistakes repeat across cultures, time periods, and market conditions. Think about the dot-com bubble of the late 1990s. Investors piled into internet stocks, convinced they couldn't lose. That was herd behavior, a bias that led to massive losses when the bubble burst. Or consider the housing crisis of 2008, fueled by overconfidence and optimism bias. These weren't isolated events. They were collective expressions of the same psychological tendencies that affect you and me when we decide whether to buy, sell, or hold. So when we talk about investor biases, we're not pointing fingers. We're acknowledging that these are deeply human tendencies. The challenge isn't eliminating them entirely, that's impossible. The challenge is recognizing them, managing them, and building strategies that protect us from their worst effects. Let's explore the most common investor biases that quietly drain your wealth. First, loss aversion. This is the tendency to fear losses more than we value gains. Imagine you invest $1,000 and it grows to $1,200. That feels good. But if it drops to $800, the pain is twice as strong. Because of this, investors often hold on to losing positions far too long, hoping they'll recover. The result? Bigger losses. The antidote is discipline. Setting stop-loss rules or rebalancing regularly so emotions don't dictate your portfolio. Next, confirmation bias. Once you believe a stock is a winner, you start seeking information that supports your view and ignoring evidence that contradicts it. You'll read bullish articles, follow optimistic analysts, and dismiss warnings. This bias creates blind spots. The fix is intentional skepticism. Ask yourself, what evidence would prove me wrong? And then actively look for it. Then there's herd mentality. Humans are social creatures. When everyone around you is buying a hot stock, it feels safe to join in. But following the crowd often means buying high and selling low. Think of meme stocks like GameStop in 2021. Many investors jumped in late, driven by hype, only to lose money when the frenzy cooled. The lesson? Popular doesn't equal profitable. Independent analysis is your best defense. Another bias is overconfidence. Investors often believe they're smarter than the market. They trade too frequently, convinced they can time highs and lows. Studies show that frequent traders underperform long-term investors because transaction costs and poor timing eat away at returns. Humility is key. Accept that markets are unpredictable and focus on long-term strategies instead of short-term bets. Anchoring bias is subtle but dangerous. It happens when you fixate on a specific number, like the price you paid for a stock. If you bought at $50 and it drops to $30, you might refuse to sell until it gets back to $50. But markets don't care about your entry point. Anchoring traps you in unrealistic expectations. The solution is to evaluate investments based on current fundamentals, not past prices. Recency bias is another trap. Investors give too much weight to recent events. If the market has been rising for months, you assume it will keep rising. If it's been falling, you expect more declines. This bias blinds you to long-term trends. For example, after a market crash, many investors stay out too long, missing the recovery. The cure is perspective. Zooming out to see decades of market history instead of weeks. Let's talk about familiarity bias. People prefer investing in companies they know, like local businesses or household brands. While familiarity feels safe, it can lead to poor diversification. Imagine putting all your money into tech giants because you use their products daily. If that sector crashes, your portfolio suffers. Diversification across industries and regions protects you from this bias. Disposition effect is closely related. Investors tend to sell winners too early and hold losers too long. Why? Because locking in gains feels satisfying, while admitting losses feels painful. But selling winners prematurely limits your upside. A better approach is to let strong performers run while cutting weak ones sooner. Finally, status quo bias. Many investors stick with their current portfolio even when adjustments are needed. Change feels uncomfortable, so they avoid it. But markets evolve, and your strategy must evolve too. Regular reviews and rebalancing help you adapt without falling into complacency. Now, why do these biases matter so much? Because they compound over time. A single bad decision might not ruin you, but repeated mistakes erode wealth. Think of it like a slow leak in a tire. You don't notice at first, but eventually, the car won't move. Consider this example: an investor who consistently holds onto losers because of loss aversion. Over a decade, their portfolio underperforms by several percentage points annually. That difference, compounded, could mean tens of thousands of dollars lost. Biases don't just cost you in the moment. They shape your financial trajectory. The good news is you can fight back. Awareness is the first step. When you recognize a bias, you weaken its grip. The second step is building systems, rules, checklists, or automated strategies that reduce emotional decision-making. For instance, using index funds or robo-advisors can help you avoid overtrading. Setting predefined investment goals keeps you focused on the bigger picture. And remember, biases aren't signs of weakness. They're part of being human. The smartest investors aren't those who eliminate biases entirely, they're the ones who acknowledge them and design safeguards. Warren Buffett, for example, often speaks about the importance of temperament over intelligence in investing. He knows that managing emotions is more powerful than chasing perfect predictions. So as you reflect on your own investing journey, ask yourself, which of these biases resonate with me? Do I hold on to losers too long? Do I chase trends because everyone else is? Do I ignore evidence that challenges my beliefs? Honest answers to these questions can save you money, protect your portfolio, and build long-term wealth. Investor biases are invisible forces. They don't show up on your brokerage statement, but they shape every decision you make. Loss aversion, confirmation bias, herd mentality, overconfidence, anchoring, recency bias, familiarity bias, the disposition effect, and status quo bias, each one can quietly drain your wealth if left unchecked. The lesson isn't to fear these biases. It's to recognize them, respect their power, and build strategies that keep them in check. Investing isn't just about picking the right stocks or funds. It's about managing yourself, your instincts, your emotions, your mental shortcuts. So the next time you're about to make an investment decision, pause. Ask, am I acting on analysis, or am I acting on bias? That simple question could save you thousands over the years. Remember, the market rewards patience, discipline, and perspective. Protect yourself from bias, and you protect your future. Thanks for watching, and here's to smarter investing.